Hi, everyone. My name is Allie Johnson, and I'll be moderating today's webinar. We'll begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our guest speaker, Justin Lewis. He's a Community and Economic Development Operations and Program Manager with People Inc. And he'll introduce himself and take us through a presentation on credit building for small businesses. As we go along, please feel free to ask questions using the Q&A function. We'll respond to them at the end of our session. And for any questions that we don't get to today, we're happy to address them through our no-cost one-on-one services or connect you with resources that can help. I'll share a recording of this webinar as part of a follow-up email. So, what is the Capital Pathways program? It is a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and it's hosted by the Virginia SBDC and George Mason University. We'll start with a program overview, then go through eligibility, and finish up with an outline of the services we offer. Capital Pathways is a no-cost, specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. And this matters because businesses that are less prepared can often self-select out or fail their loan applications, and these early failures correlate to a lack of adequate capital. Ultimately, only half the loan amounts that are requested actually reach small businesses. So to put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow, but only 20 to 30% of those who apply actually get their loans approved. So to help address this challenge, Capital Pathways creates a path to financial and legal readiness. Our program offers an immersive, hands-on group experience paired with one-on-one support. Who's eligible, you may ask? Very small businesses and nonprofits at any stage who face challenges accessing traditional financing. Our services include a guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and credit building advising. We start our process with a self-assessment that pinpoints your business's key gaps so we can connect you with tailored resources, either through our program or through other resources that can help. Under our legal structure validation, our in-house advisors can help you through basic legal questions, and we partner with a law firm who can help with the more complex questions related to business registration, trademarks, and contract and agreement reviews. We also offer financial webinars on topics including financial basics, financial statement preparation, and QuickBooks training. Our one-on-one tailored advising support covers business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender preparation. Our loan readiness services include both webinars and one-on-one individualized support, and these webinars cover topics such as what lenders look for in loan applications, interactive mock loan interviews, SBA loan options, and sample application analyses. We also have a partnership with a lender who can provide one-on-one support for those looking for capital. Finally, our credit building advising helps you review and interpret your credit reports as part of building an individualized credit improvement plan to strengthen your credit and help you qualify for the best financing options and terms possible. So if you're interested in getting started with us, you can reach out through our website, which is virginiasbdc.org/programs/capital-pathways, or you can contact me directly at capitalpathways@virginiasbdc.org. And I'll go ahead and share my email and our website and link in the chat for everyone to have. So with that all out of the way, we'll go over to introductions. As I mentioned, my name is Allie Johnson. I'm today's moderator and serve as the program and intake coordinator for the Capital Pathways program. My professional background is in economic development, small business support, and access to finance projects, both domestically and internationally. Our session today will consist of a 90-minute presentation And again, please feel free to ask any questions throughout the presentation using the Q&A function. We'll respond to them at the end of our talk. Any questions that we can't get to today, we'll be happy to address through our no-cost one-on-one services, or again, connect you with resources that can help. And as I said before, we'll share a recording of this webinar in a follow-up email. I'd like to now pass things over to Justin to introduce himself, tell us a bit about his background, and start the presentation.
Thank you, Allie. It is my pleasure to be here. I am going to share my screen. Hello, everyone. My name is Justin Lewis. I'm the Operations and Program Manager of Community Economic Development at People Inc. Financial Services. I'll talk a little bit about who we are and what we do here in a minute, but I'm glad to be here and for another session of this Credit That Works webinar. As Ali said, please, this works much better as a back and forth. So if you have questions, please put them in the Q&A. If you need things explained in a different way, explained with a little bit more perspective, I can do my best to do that and make sure it's meeting the needs of the folks on this webinar today. So what we're going to do today is we're going to explore what credit is, how it works, how to build and maintain it wisely, and specifically how your personal and your business credit intersect. It's a really important space for all current and aspiring entrepreneurs to navigate. Everybody has to interact with it at some point. So it's a really crucial one that we cover today. So that's what this focuses on. Now, this material was developed by PIFS, People Inc. Financial Services, as part of our community economic development efforts. I am a certified credit counselor with the NACCC, helping individuals transition often from personal finance to entrepreneurship. And all of our trainings are designed to be practical, relevant, easy to apply, the way you will interact with the system. So a little bit about PIFs. We are what's called a CDFI, a Community Development Financial Institution. CDFIs are all independent, nonprofit, often nonprofit financial institutions with missions that are tailored to their own communities. So we provide affordable, responsible capital, as well as financial education, technical assistance like this training we're doing right now, in order to support financial stability, community growth, job creation, entrepreneurship. Our ultimate goal is to increase access to entrepreneurship. We want more small businesses, not less. And so that's the work we do every day. Some outcomes, some PIFs specific outcomes from our last fiscal year. We deployed nearly $2 million in small business capital. That is a number we're very proud of because that is capital directly invested into our community that small business owners and entrepreneurs would not otherwise have access to. So that's a number we're very proud of. We also have a consumer lending program right here. You can see a little over $400,000 deployed there, as well as over 17,000 hours of technical assistance deployed last year to over 100 businesses, as well as a large number of jobs created. We serve 40 counties and cities in the state of Virginia. You can see them here, 24 of them down in Southwest Virginia, and then another 16 up in the Shenandoah Valley and Central Piedmont. So let's roll into today's content. With a disclaimer, always, this is for education purposes only. I am not a financial or legal advisor. Every choice you make about your money and your legal status and your business's entity, those are all entirely up to you. When you leave this training, please go talk to a licensed advisor if you'd like to do that. Also, the point of view, the perspectives, everything that I say in this training today, that comes from me. It does not represent our agency entirely. And then obviously this stuff is subject to change. It's law, it's policy, it's regulations. It could change later today, it can change very rapidly. So make sure you pay attention to that. So today, specifically, credit networks. We're going to set a baseline of personal credit scoring and reporting, how that works, how you understand it. So then we can look at business credit scoring and reporting and how it differs. Then we'll look at how they intersect, what's similar, what's different, how they compare and contrast. And then we'll take a snapshot look at business credit products, the types. That's a big part of our work, is I don't endorse any particular product, any individual product, but the types of credit products and how your business will interact with them. And then how do you prepare when you're going to go out and actually apply for business credit when you want to build your business? So, basic question why, that's always where you start, is why is this important? On the personal side, there might be things like paying for college. That was the only way I was able to go to college. I didn't have the money to go. You might want to make a major purchase like buying a home or a vehicle or a piece of equipment. You might want to get some business capital to invest in your business, like get a small business loan. It also, your personal credit affects things beyond just borrowing rates. It also affects your interest rates. It can affect your security deposits when you go to rent somewhere. Now, these all, on the personal side, fall under one category, which is wealth building. Credit is not wealth. It is a tool to access wealth or to build wealth. So these all fall into the category of wealth building tools. Now, on the business side, credit can be a tool to help you invest in and grow your business. You might need access to credit to take it to the next level. It might not be something that you can always entirely fund with revenue that you have on hand at every moment. There will be, or there may be a time with your business where you need access to credit to get to the next level. It can help you weather the ups and downs of your business's cash flows. Every business has seasonality. That's the case all the time. And it's just how and on what rhythm and on what cycle. So the credit can often help you weather those. It might help you win bids, contracts, attract investors. You might want to be able to be a government contractor. If you work on lawns, federal buildings need their lawns mowed too. So credit can be a tool to access those. Too often, something we see with small business owners is that they can be a little bit skittish to invest in their business, but if done patiently, strategically, and at the right time, there will be and often can be a right time to invest and a right way to invest. So there is no one answer. There's no everybody should do it at this point. You'll have to do it. You'll have to make those decisions for yourself. But under investing can be a risk, just like over investing can be. So to set the foundation for how they intersect. So your business credit starts at your personal credit. And what I mean by that is that business credit doesn't materialize out of thin air. If your business is new, that means your business doesn't have credit history. So what they will do is assess your personal credit history to assess your creditworthiness. And so they are linked in that way. You can still, the credit may very well still be in your business's name, but the history that they will use to build that on is your personal credit history. Your consumer reports are details, and we'll talk about some of those. And your commercial reports or your business credit reports are summaries. We'll talk about that a little bit in this training. Everybody has what you can consider a credit story. Facts and figures matter. The data matters, of course. But if you have a coherent narrative for why things look the way they do, that'll generally support your proposal, even if those facts and figures aren't as perfect as they could be. An example, medical crisis. Maybe you had an interaction with predatory lending and you were getting things untangled from that, or maybe you went through a separation or divorce a few years back and your finances were tied up in that. If you have a coherent narrative for how you're navigating out of that, that can be a really strong indicator for how you're performing going forward. The important thing with your business credit starting at that personal credit point, what that means is that investing in your business starts sooner than you think it does, than most people do. Like it's not a turn the spigot on, turn the spigot off kind of scenario. You may not be investing in your business for 2 years, 3 years, 5 years, but since they will be assessing your personal credit performance to to evaluate your business's credit worthiness. That means investing in your business is going on right now for everybody on this call, everybody on this webinar, because you're at least thinking about building a business. So getting your personal credit in order and understanding it and building it up and stabilizing it and showing consistency, that can help you build your business later down the road, even if you don't know what the timeline is yet. So let's take a close look at personal credit reporting. This is sometimes called your consumer credit report. What it tells us are the details of your credit history as it's been reported by the lender. So it's important to remember there's not a universal credit history. There's not, it's not your permanent record, so to speak. It is as it's reported by the lender. So which means it can vary, which means it's going to be based off what the lender, what and how the lender reports it. And so how you've experienced it and how the lender reports it aren't always exactly a one-to-one scenario. What it tells us is the type of credit that's used, so revolving, auto, personal loan, student loan, those kinds of things, how long it's been opened to the month, and then whether those bills have been paid on time, going back 24 months. It will show us 2 years of payment history. The personal information that's on your consumer credit report is your personal identification information. So things like your date of birth, your social security number, addresses you've been associated with. It's going to show us the account history, and it's going to show us the creditor, the bank, that the financial institution that it was with, so Capital One or JP Morgan or whomever. The payment history going back 24 months, like I said, and then also the balance. It's also going to show us the public records, so meaning things that are in the public record. As of 2018, on your consumer credit report, it is only bankruptcies. It used to show things like your child support and your alimony and your tax liens. It does not anymore. It only shows those bankruptcies unless they become delinquencies. Assume that any delinquency is going to show, even if it wouldn't show if it was not delinquent. But, if you just owe child support, like if you're paying child support, it's not going to show that. But if you become delinquent on child support, it'll show that as a delinquency. Otherwise, it's only going to show bankruptcies. And then finally, it's going to show inquiries. Now, inquiries are when you've inquired about credit. There are two kinds. So there's your hard inquiry and your soft inquiry. A hard inquiry is when you've applied for credit. You signed at the bottom. You said, I am applying for this. If you give it to me, I want it. Those show on your credit report for 2 years. They really only affect the score for about 12 months, but they do show them going back 2 years. Then they also have soft inquiries. Soft inquiries are for consumer disclosure purposes. They are for, maybe you have an existing creditor, they pull a soft inquiry to see how you're performing, just so that they can have that for their records to upgrade and downgrade your account based off their, portfolio metrics. When you pull a consumer disclosure of your own report, which we'll talk about here in a minute, that is also a soft inquiry. Since soft inquiries are for information purposes only, they are not official applications, they do not affect your credit score. They are not, it doesn't show up as a hard inquiry. You didn't apply for credit there. So it does not affect that score in any way. Now, when you go to obtain a report, first of all, it's important to remember that a report and a score are not the same thing. The report are the details. It's the data, it's the information. The score is then calculated based off of that data. And we'll talk about scores in a minute. But obtaining a report, reasons you might want to do that, maybe you're applying to jobs. You're applying to jobs, or maybe looking to make a career change of some kind. You're moving somewhere. You're making a major purchase, like a home or a vehicle. Maybe you're going through divorce or separation and you want to see how things are being reported, what's tied together, what's separate. Maybe you're trying to ward off or prevent or recover from some identity theft. Somebody got your information and applied for credit in your name, or you're just trying to prevent that. You may just want to set goals. You want to invest in your business in 2 years, and you want to see how things are reporting now because you know you're going to need a business loan in at the end of next year. So you look at how things are now. Okay, well, that's enough time for me to work on. If I get this cleaned up, if I keep building this, because it's not always about bad things. Sometimes it's about building on the positive actions. These all fall into one major category as well, which is anytime somebody else is going to be looking at it. So you're applying for jobs, you have a landlord who's going to be examining it, and on and on and on. You always want to look at it before somebody else is going to look at it. You never want anything on your credit report to catch you by surprise. You don't want to find out something's on your report or showing up in such a way that you know that you're the last to know about it. You want to be able to, especially if it is something maybe a little bit derogatory, you want to be able to know that and anticipate those questions because a responsible lender will ask you about it. Now, where do you go to obtain one of those reports? This website right here, annualcreditreport.com. This is the official one. It's the only official website. There will be imitator sites, but this is the actual one, annualcreditreport.com. You can go on and get free access to your credit reports, one from each of the three credit bureaus. You can go on there and get it totally free of charge at no consequence. Remember, it's a soft inquiry, so it does not affect your credit. Now, I just said three credit bureaus. So there are three major ones in the US: Experian, TransUnion, and Equifax. Those are the three major consumer credit bureaus. Your report from each of the three of those will vary by each bureau. Now, the reason that is because each of these bureaus is an independent company. They are a private institution, and so they have different subscribers, which means they have different info being reported to them. Also, creditors report it differently. Remember, I said that it's as reported by the lender. So some creditors might report in batches. They might not report on time regular payments. They may only report delinquencies. There can be some variety there. You will need to pull a report from each of the three bureaus separately. They don't share information back and forth. You want to see how it's showing up on each because it'll be a little bit different. If there are errors on there, you know, your name's spelled wrong, your date of birth is wrong, there's an address that's associated with you that is not yours. It's a lot of data. Everybody in North America has one. They get things wrong. If there are errors, you will want to dispute it and then resolve it. So basically the dispute process is you go onto Experian and you say, hey, my middle initial is wrong. I'm going to dispute that. And they go, oh, and they look and you might need to provide proof or whatever, and then they'll fix it. It is important to do that, to dispute those errors and correct them. You want these reports to be as accurate as possible to prevent there being any errors or problems. Give me just a minute. I'm going to pull up the Q&A panel. Great. And you are entitled to a free, no consequence credit report from each of the three bureaus once every 12 months. So once a year, you can go on and request one of these consumer disclosure reports, a soft inquiry, and just for review purposes, to know this is what it looks like. You're entitled to that by federal law. So everybody gets that. The three bureaus have made their reports available once per week by their own policy. They've noticed that people perform better when that's the case. So you can go on there and get them as often as once per week right now, but by law, you are entitled to them once per year. Now, when you go to apply, this is the ideal candidate. And this is, ideal is not always realistic, but the ideal candidate is going to have 3 to 4 revolving accounts with really high credit limits and really low balances. Revolving, something like a credit card or a line of credit, meaning you borrow against it and pay it off and borrow against it and pay it off. It revolves up, it revolves down. Now, the reason you want high limits and low balances is because of this thing called credit utilization. They want to see you have a bunch of credit that you don't need. That is a sign of being able to manage your credit well. Ideally, They never want to see that number go over 30%. Now, what I mean by that is let's say you have three credit cards and between them you have access to $10,000 worth of credit. They never want to see you use more than 3,000 of that 10,000 at any given time. It never goes above 3,000 before you pay it down or pay it off. That's called credit utilization. So they want to see you have a whole bunch of spare credit. If you're running your cards around maxed out all the time and you're at really high utilization, that's a little bit of a red flag. They want to see you have a stricter card, like a travel and entertainment card, one that has stricter rules, that is quicker to revoke privileges. And they want to see you manage a really high quality card. Elizabeth Cannon, you said the ideal candidate. Yes, we are establishing right now a baseline. This is on personal credit. Right now, as you, the individual on your personal credit side, are navigating the credit system, these are the things you want to work towards to show credit health and credit strength. We'll talk about business credit here after we talk about personal. Good question, Elizabeth. They want to see your trade lines be old, at least 6 months old, but ideally more than 3 months or 3 years, excuse me. Basically, they want to see you manage credit over a long period of time. No derogatory items of any kind, so no late payments, no delinquencies, no repossessions, things like that. Few inquiries, not no inquiries. Everybody has to get credit sometimes, but a couple times a year, if you go out in batches and say, I'm getting an auto loan, I'm shopping around, I get a couple of different quotes. What they don't want to see is you going out every month and trying to apply for credit over and over. It makes you look what's called credit hungry. And that makes them wonder, why does this person need credit so much? Is it financial mismanagement? Is there's cash flow inadequate? Is that, it's a behavioral indicator. And then they want to see at least one installment trade line. So not just revolving. They want to see you make an installment payment over time. So your auto loan, your student loans, your mortgage. They want to see you pay consistently over time. They don't want to see just credit cards or just lines of credit where you're just paying down what you borrowed. They want to see you make steady payments over time and then pay things off. So let's talk about your personal credit score. So that's the report. Those are the basics of your report. The score is the calculated risk of lending you money expressed as a numerical value. And they take this data from your credit report, they put it into a financial model, and then they say, how likely are you to repay expressed as a number? On the personal side, that number ranges from 300 to 850. So 300 on the low end, 850 on the maximum. The industry standard is called FICO. You hear this one a lot. It's in, ads and if you go in and, to an auto lender or something, you'll say your FICO score is this. They've been around since the 1950s. They've been around a long time. They do have a competitor called Vantage Score that's been around since 2006, but still popular, emerging. And the underlying principles to both FICO and Vantage Score are the same. They're not, there's not some philosophical difference. They just have different scoring models. Vantage Score starts to calculate things a little bit sooner. Things start to affect your credit a little bit sooner, which has its own ups, pluses and minuses. FICO score is slower to respond to those things, which again can have kind of its own pluses and minuses. Now, there is no one credit score. There is your credit score in that moment based off of what you're applying for. Now, what I mean by that is a credit score is a snapshot of your credit worthiness in the moment that it's drawn. So one, data changes. And so the score is going to change over time. As the data going into it changes, the data going out of it is going to change. So that can change, daily. But it's also based off of what you're applying for. So they're going to have a different scoring model for your auto loan than they are for your credit card or for your mortgage. And so the Experian Auto 4 is going to calculate your score in that moment for that particular loan differently than if you're getting the TransUnion Mortgage 8. That scoring model is going to be designed differently to emphasize different things, put, weight things in different amounts. So there is no one credit score. So you go in here and you say, oh, my credit score was a 700, but then you go in for this different product and it's a 680. That is based off of which bureau they're using and what scoring model they're using. It can vary widely. So what goes into, again, we're using FICO as an example. The underlying principles of Advantage are the same. What it considers, number one, the biggest factor, payment history, 35% of the score. Do you pay on time? Do you pay as agreed? That's the biggest thing. The thing to remember here is that more recent actions factor more heavily. So a missed payment 2 months ago matters more than a missed payment 2 years ago. Next behind that, also still very important, is how much do you owe? So this is the raw balance. Have you borrowed a lot of money? You have your mortgage and you have a big auto loan, you have a bunch of student loans. You just have a lot of debt to pay off, but also that credit utilization that we talked about. How much of your available credit are you using? So to reiterate, less than 30% is ideal. You never want to see that number go over 30%. Remember that that's global. That's all of your credit put together. Next behind that is the length of credit history. So how long has it been open? So the oldest accounts you have, the newest accounts you have, and the average. You want it to be at least 6 months old. For FICO, it's got to be at least 6 months old to even really qualify to affect the score. And then the smallest factors, credit mix. So do you have a variety of credit, revolving, installment, mortgage, auto? Best practice here, don't take out unnecessary debt just to improve your mix. It's a pretty small factor all told, but organically, as you're growing into your credit identity, let it grow organically over time. They don't want to see just credit cards. They don't want to see just one installment loan. They want to see you manage a mix of credit. And then finally, new credit. This is primarily only a negative factor, meaning do you have a whole bunch of new credit? And it's negative mostly because one, it can make you appear credit hungry. Why did they go out and get a whole bunch of credit all in one fell swoop? Are they in an emergency situation? And then two, they just don't know how you're going to manage it over time. There hasn't been enough demonstrated activity yet. So that's basically they just want to make sure you don't have a whole bunch of new credit. There are things that FICO does not consider. Some of them they cannot consider by law. So demographic information, your race, your color, your religion, none of those are allowed to be factored into your credit score. Your age does not factor into your credit score at all. Your salary, your occupation, your title, your employer, those are in your FICO score. Now, that doesn't mean that the lender won't want to know those things. They absolutely will. The first question at the top of your loan application is how much money do you make each year? So the lender wants to know, and they're going to factor it in, but it's not in your FICO score. Where you live, it's not different because we live in Virginia rather than Colorado. The interest rates on the other accounts you've paid, that's not in the score at all. Your rent does not factor into your credit score. Things like your child and family support, alimony, unless they become delinquent, you don't get credit for paying those on time. You're just expected to pay them, kind of like your taxes. But if they become delinquent, they show up as delinquencies. Your non-credit banking information. So your deposit accounts, your checking account, your savings account, again, unless they become delinquent. If the bank has to send those to collections, they may show up as a collection on your credit report. And then finally, those soft inquiries, those consumer disclosures, somebody pulling the report just for review or a creditor of yours pulling it just for review. One of the most common questions, what's a good credit score? What do I need? That's a big old, it depends. It depends on the financial institution. It depends on their risk appetite. It depends on how much you're applying for what, when. All of those things can vary, but generally the higher the better. You want it as high as possible. So One place may have their cutoff may be a 700. Another place their cutoff may be a 680 or a 650. But just the higher you can get it, the better. If you're up over 720, that's usually about as good as it's going to get. But even then, a good credit score, quote unquote, doesn't guarantee you to anything. If I go out and I'm trying to get $1 million business loan, but I only make $30,000 a year, I could have an 850 credit score and they're probably still not going to give that to me because I can't read. There are other factors that would prevent them from giving me that loan. So, a little bit about delinquency and rehabilitation. If you, again, we're still in the personal credit category. So, what happens if you get behind? The big thing here, uh, positive actions equal improved score always, 100% of the time. It is based on data. So as the data changes, the output is going to change, the score is going to change. So the upside of that is it's not like I liken it to diet and exercise where you're kind of like, is this working? It's like this invisible effort. You don't have to wonder that. If you are taking positive steps, it will improve 100% of the time. But what that means is that you must have active trade lines. Just not doing anything is not active, is not a positive action. That's just a neutral action. So sometimes just resolving your derogatory accounts alone will not improve your credit. So the cycle of debt, say you get you're managing your debt. First category, active, in good standing. This is healthy debt. It's current. It's on-time accounts. You're paying them as agreed. It's also any account that you've paid off in the last 10 years. So you paid off an auto loan 6 years ago. It's still sitting there as a good, active, in good standing, positive mark in your credit history. The next phase is it's late, but it's still active. So it can be made current. You could pay, the back payment and the current payment, and then it would move right back up to that green category and become an active and in good standing account again. It's really important to catch any account here before it is what's called charged off. A charge off is when whoever the financial institution is, they charge it off of their books and they say, we're not going to be able to collect this. We're marking this off as a loss. And then they might send it to collections. They might have an internal collection agency. They might sell it to a collector, or they may sue you for it. That's what a public record would be, a judgment in that case. The reason you want to catch them before they come here is that once it becomes a charge off, it can never be made active ever again, which means it can never be a positive action. Even if you settle it, you work it out and they're not coming after you for the debt anymore, it can no longer be an affirmative, a positive action. The best it can be is a neutral one. It's not the end of the world. If you do have something that gets charged off, remember what we said earlier, as things age, they factor less and less. So as you let a derogatory item age and replace it with positive actions, those things in front of it, more recent, matter more. So over time, you will replace the derogatory item with positive actions. So there's a timeline to this on the personal side. There is an essential date called your date of first delinquency. Now, this is by law 30 days from the day that it became late. That's when it becomes delinquent. That is required by federal law. So you have 7 years from that date of first delinquency is how long it will show on your credit report as a delinquency. That is, unless you bring it current again, and then it became delinquent again, but then that would be a different delinquency. So it would have a new date of first delinquency. It's important to remember your date of first delinquency never changes. It is locked. So you become delinquent on September 2023. Okay, that's locked. 7 years from that month is how long it will show on your credit report as a delinquency. This is different from what's called the statute of limitations. The statute of limitations is how long the lender has to sue you for the debt. Now, this timeline varies based on the kind of credit it is, and also it's governed by the states. In Virginia, it is 3 to 6 years, depending on the kind of debt it is. The statute of limitations can change. So if you acknowledge that debt, if you make a couple of payments, if you do a workout, that does reset or can reset the statute of limitations. Excuse me just one moment. Sorry, I had a sneeze come and I scared it away. But the statute of limitations can reset. So you do any of those things I just mentioned, it can reset and they have a new 4 years to sue you for the debt. The date of first delinquency does not. So unless, again, unless it becomes current and you become delinquent a different time. So that means your strategy to approaching how you're going to manage a derogatory item is going to be based on this timeline. Are you 5 years into this timeline or are you 6 months into this timeline? That's going to affect how you treat that. There is an exception to these two timelines, which is bankruptcies. Bankruptcies appear on your credit report for 10 years. They are a unique item. They have their own 10-year timeline. A couple of tools to use on your personal credit report are credit alerts and freezes. These can be if you're dealing with identity theft or you just want to maybe lock yourself out. What a credit alert does is whenever somebody applies for credit, they have to contact you directly. They literally call you on the phone and say, "Hey, Justin, somebody just applied for an auto loan in Southwest Virginia. Is that you?" And you say, "Yes, it is. Let it go through." Or you say, "No, it's not." And then a credit freeze is it freezes your account entirely so nobody can apply, not even you. And so if you needed to go apply for credit, you would have to lift that freeze to go, apply for your auto loan or whatever. These are great for, like I said, identity theft. You might just want to set personal limits. You want to say, I don't want to take any new credit out for the next year. It's good if you're separating your accounts from somebody else so that you can, so that your things aren't getting tied up with you when you're getting them going through some kind of financial separation. You do have to set these alerts and these freezes separately with all of the three different bureaus. So there's not like one universal freeze. You have to go in and do it with each of them. You do have rights, and the two major pieces of legislation that govern consumer credit reporting are the Equal Credit Opportunity Act, which says you must be informed within 30 days of applying for credit, whether you've been accepted, rejected, or incomplete. They must tell you why, and then they must tell you which credit bureau they used. And then the Fair Credit Reporting Act is what governs how and when and what the lenders report on the consumer side. So we use that as the baseline. Everybody here, we all interact with personal credit. So how does that affect our business credit? So your personal credit is attached to your social security number. That's like we talked about earlier. Your business is going to be attached to your EIN, your employer identification number. Most business loans, when you're starting out, especially if the business is new or at the micro enterprise level, it's just you working for you, are going to require a personal guarantee. A personal guarantee means that you are giving a legal promise to repay your business's credit accounts if the business can't make those payments. So you are personally guaranteeing those loans. The SBA loans, the Small Business Administration, they require anyone with 20% stake or more in the business to have a personal guarantee. So a lot of times they are required when you're just starting your business out and the business is new and there's no demonstrated business credit history, they very likely will ask for a personal guarantee. Business loans, commercial credit products that are, they're coded specifically as a commercial credit product may or may not appear on your personal credit report. I've worked with people who they had a commercial credit product on a commercial property, and even though they had a personal guarantee, it didn't show up on their personal credit report because of the way that bank handled it. So that may or may not be the case. The key difference here is that there are many fewer regulatory standards on the commercial credit reporting side or business credit. I have here no regulatory standards. It's not quite no, but it is way fewer than on the personal side. Everything I just spelled out in the first 3/4 of this training about Personal credit is all mandated by law. That is all very much set by federal and state legislation. On the business side, it is much more pay to play. It is a paid service that you're opting into or not. So, an example, there are no free reports of any kind. You can only get a business credit report by paying for it. The delinquency timelines, remember on the personal side, it is set at 30 days by law. On the business side, it's going to be set totally by the lender. It is up to them when they consider something delinquent. So they might consider that 1 day, they might consider it 5 days, they might consider it 30 days. These scores and these models on the commercial side are proprietary. They are a paid service. The underlying principle remains pay on time, pay as agreed. If you do that, you are building positive actions and building positive credit history as long as you're observing that underlying principle. Your commercial reports, there are the major players here. Dun and Bradstreet, that's the one people know, and we'll talk about why that's the one people know. But D&B, you'll sometimes hear it called. Experian and Equifax also have commercial reports. TransUnion does not. They choose to only do consumer credit reporting. The scores for your commercial credit report range from 0 to 100. So 0 on the low end, 100 on the top end. So these are paid services. So it is a subscription service. So it may be cost prohibitive for your business to pay for this until you're at an investment point. Say you may want to subscribe for a specific period of time while you're working on a specific goal. And then what this means is that other people, other businesses can view your report for any reason if they're willing to pay the fee. So there are regulations on that on the consumer side. We are only allowed to pull your report with your consent or, when you've signed this thing. In the commercial credit reporting space, anybody can do it as long as they're willing to pay that fee. Now, logic stands that they would only pay that fee when there's some kind of vested interest in doing it. So I think that's the idea that, your information is safe because who would pay for this if it didn't benefit them? But that remains to be the case, though, that they can access it if they want to. And then your DUNS number, your DUNS, your Data Universal Number System. This is why people know Dun and Bradstreet is this DUNS number. You used to need a DUNS number in order to bid on government contracts. You had to have one. It was your identifier with the federal government contracting database. That is no longer the case, though. Now they have their own unique coding system. It's called your UEI, your unique entity identifier, I think. Yes, unique entity identifier. So you no longer are required to have a DUNS number unless you're participating in the Dun and Bradstreet credit reporting. But that's why people know D&B more than the others. It's also important to remember, like I said, way back at the beginning of the training, these are summaries, not specifics. And so, which means they're not going to be comprehensive. We'll talk about what that means here in a minute. The information that's on it, on your commercial report, your business's identification information. So your entity, your registration with the SEC, with the state corporation commission, your EIN, things like that. Your business's credit history, but it does not include the name of the lender or the vendor. So if you have a line of credit at Office Depot, that's going to show up as Office Supply Store rather than naming Office Depot. And then they use a phrase in commercial credit reporting called slow pay. And what that means, it might mean that you're past due, it might mean that you're delinquent, it might mean that you're a habitual slow pay, but it's kind of a catch-all phrase, slow pay. In the commercial side, they may show your current balance, they may show your high balance, they may show your average balance, they may show your due date. So it's going to vary a lot based off the lender and how they choose to report it. Whereas on the consumer side, it is much more regulated. It's dictated how and what to report. And on the commercial side, it's much more up to that vendor and that lender how they're going to do it. It also shows your business's legal and public records. So remember, on the consumer side, it was only bankruptcies. On the business side, it is your bankruptcies, yes, but it's also any of your UCC filings. It's also any liens or judgments. Outstanding taxes. It might be any collections that are on your business. So it's going to show the full gamut of public records for your business. It's going to show your business's credit inquiries. And again, this is the number of times that a creditor or interested party has viewed your report. So this isn't just when you apply. This is anytime anybody has inquired. So again, hard inquiries are still going to be when you applied, but soft are going to be for account monitoring, pre-approvals, things like that. How long they stay on the commercial side is going to vary, also based off how the lender wants to manage that. But the same underlying principle of too many inquiries is a red flag because it shows a lack of stability. The information that's not on the commercial side is going to be your personal information. Your social security number, your addresses, your accounts, those aren't going to be on there. Your personal credit accounts. Your business's financial statements are not on there. Your P&L, your balance sheet, your cash flow statement, none of those are on the credit report. Your business's banking information, so those deposit accounts, that's not on the credit report. So let's look at business credit products again, kind of by category. The major categories here are business credit cards, vendor credit, business loans, and lines of credit. There are 500,000 vendors in the US, business to business vendors. 10,000 of those report to a credit bureau. So that's something to consider as you're building your business's credit history. Local vendors are often easier to work with. They're better to work with for relationship purposes than the needs of your business, but they're the least likely to report to the bureaus because it carries a cost. Remember, we talked about these are proprietary models. It can be cost prohibitive to smaller businesses. So that's something to factor in as you're building your business's credit history. Does this vendor report or not to the business credit reporting bureaus? That's not always necessary to get business credit, but if you're trying to build a credit history, it is. We're going to look at these in order, ascending order of cost. So we're going to start with the cheapest kind of capital and go up to the most expensive capital. So your cheapest capital is your term loan. You're going to go, you're going to get a bank, a credit union, community lenders like CDFIs, or sometimes they're revolving loan funds. SBA loans are term loans. So these are best for large purchases, property, startup costs, projects that won't be paid until the end of a contract, things like that. The thing to remember here is match the term to the purpose. So the term of the loan. So you don't want to be paying for inventory that's only going to stock your store for 3 months. You don't want to be paying for that for 5 years. That's really hard to manage your cash flow if you're constantly paying for something that's no longer generating revenue. So match the term to the purpose. If you're buying a company vehicle and it has a useful life of 5 years, you pay that off over 5 years. That's great. You're matching the term to the purpose. But that's really important to remember as you're navigating your business credit. Next up in cost is a line of credit. So a line of credit is a piece of revolving credit, meaning you borrow against it, the balance goes up, you pay it down, the balance goes down, and then you have access to it again. So revolving, it revolves up, it revolves down. Lines of credit typically have what's called a draw period and a repayment period. The draw period can be any length of time, sometimes many years. I think the draw period I have on my business line of credit is like 10 years. But that means you can draw down off of it and you can draw it down in cash. So I can draw it down and put it into a cash account. Sometimes you might need that to make payroll or pay certain vendors who only take cash. And then at a certain period after the draw period, it locks in to a repayment period where it becomes a term loan. It locks in and becomes, okay, now you owe this over a specific term. During that draw period, you can pay it down typically as well. These typically carry no grace period the way a credit card does. So you start paying interest on it as soon as you pull those funds down. Interest starts calculating right away. These are most useful for large volume inventory or supply heavy businesses. So, where your accounts receivable and your accounts payable don't line up perfectly. That's very rare for any business, but you have to pay your expenses on this end, and then you get compensated for them when you generate a sale. And so a line of credit can be used to match those up. And so sometimes retail businesses will use a line of credit. Sometimes, like I said, a supply heavy business, we have to build something. We're a manufacturer. We do that, and then can't actually generate revenue for us until we generate a sale out of it. That's when a line of credit is going to be useful. Vendor credit. So this is where you're financing directly through the vendor. There are two types of vendor credit. There's invoicing. So you have your period, you go to the vendor and you use this many services over a period, and then at the end of that period, they bill you for it. And then you have a period of time to pay it back, 15 days, 30 days, 45 days, 90 days. You want that net to be as long as you can get it. Really, this is how mechanics work a lot of the time. They have the auto parts store. They tell the customer, "Hey, we got to buy you a fuel pump," and they bill it to the customer, but they buy it from the auto supply store. They get it, and then at the end of the month, the auto supply place says, "Okay, these are all the parts you bought over the month," and then they use those paid for invoices from the customer to pay off their supplier. That's invoice financing. But there might also be vendor financing where you're financing rather than through a bank, you're financing it, making payments to the vendor. Really common with big like equipment companies, Kubota and these kinds of places. Lawn care equipment, sometimes supply and inventory companies. If you're a food service, you might finance directly through them because you got, a commercial grade stove or something like that. These are vendor credit is best for establishing those long-term relationships. Your business is interacting directly with this vendor all the time. You're getting weekly shipments or maybe every day or however often you get them. But these are also the least likely to report to the business bureaus. So unless it's a really large national distributor, it's going to cost them to report. So a lot of times the smaller ones aren't going to. And then finally, the most expensive version of credit, or, as far as mainstream types, are credit cards. These can come in the forms of a store or a vendor card, a corporate card, just your standard business credit cards that you get the ads for. If you've established an LLC in the state of Virginia, you have definitely gotten credit card offers in your business's name. I know that to be true. I run a couple of businesses with my wife, and so these are best for your regular cyclical expenses, things you have the money for. You don't need to borrow for, but you're not going to necessarily go, man, processing a purchase requisition for every time you have it. Things like fleet cards. You have 5 company vehicles and they go out and they've got to fill up their gas tank. You're not going to generate a purchase requisition for every one of those. So you have them get gas when they need it and log it in whatever way your business does. And then you pay that invoice at the end of the billing cycle, end of the month. You don't want to typically carry a balance on any credit card, personal or business, but it's very expensive capital. We're talking sometimes 20 to 30% interest on these. So you rarely want a balance to sit on a credit card. You just want to use it for lining up transactions from month to month. These can be a tool for establishing business credit. A lot of times people are like, well, how do I get it? What's my foot in the door? Sometimes a credit card can be a foot in the door because your credit limit can be manageable. And it is important to remember, this is true on the personal and business side. You do not need to carry a balance for it to build your credit history. You just have to use it. You have to use it enough to kind of keep it active. That's going to vary based on the card. Might be once every 2 months, might be once every 6 months. but you do not have to carry a balance in order for it to be building your credit. What you do have to do is pay it off in total, but that can be sometimes a good way to get started. Is you open it in your business's name with your business entity, and then you use it over time, and then they say, okay, and now you can get your business's line of credit. Now you can get a term loan in your business's name. Sometimes it can be a stepping stone. A credit card on both the personal and business side is, when used correctly, a short-term, low-cost loan to yourself in order to manage cash flow. I'm going to have the cash flows to pay this off in 2 weeks, the expenses today. I'm going to line those up using my credit card. Now, any of these products might be secured or unsecured to collateral, so be prepared to discuss collateral. Collateral makes the credit cheaper. It is considered lower risk for the lender. So anytime you can attach collateral to it, it's going to be at a lower cost. It's also important to remember that when you're applying for business credit, that business assets, meaning, your equipment or your inventory or whatever, are weak collateral. They are discounted heavily by a lender and an underwriter because they're worth more to you than they are to the lender. By the time they come in and they collect on say you run a boutique and they come in and they get your dresses or whatever, your men's suits, and then they auction those off. What are they going to recoup? Because they had to pay somebody to do all that. It's not worth as much when you auction things off. So just be prepared. Business assets are weak collateral. So if you're trying to get a good piece of credit or a large amount of credit, you're going to need stronger collateral than that. There is sometimes something called emotional equity, which means it's something that's in your business that means more to you than it does to the lender. Its real world value is not that high, but the borrower shares in the investment because they don't want to lose it. That can help strengthen the lender's buy-in because they're like, okay, well, we know this person won't want to lose this bit of emotional equity in their business. And then remember that you can't pay all expenses with credit. There are certain liabilities that you must pay with cash. Your tax liabilities, you can't pay taxes with a credit card. Some vendors only take wire transfer or, from bank to bank. So if that's the case, that's when you would use something like a line of credit if you need to use credit to manage that. So keep that in mind. So where do you go to look for business credit? First place you're always going to stop is your bank, your credit union. It's important to have a relationship with a banker, not just a bank, because a really good banker will be able to help you navigate your options for you at that time. They won't just be trying to get you into the highest price thing. They'll be trying to get you into the right thing. Your vendors, your suppliers. There might be nonprofit or community lenders. So we're a CDFI, Community Development Financial Institution. We lend money to small businesses, but there might be revolving loan funds in your community. Your economic development authority may have small business capital that you can borrow and repay on usually pretty forgiving terms. And then when you're looking at online lenders, you want to look at licensed and reputable ones. Tread lightly in this space because it is a really new unregulated industry, so not all credit from online is the same. Some of it's great quality credit that you would get at the best banks, and some of it is very obscure. You don't know exactly what you're buying. So just tread lightly when you're looking at things like merchant cash advance and lease financing. I'm not ever here to tell anybody how to spend their money. They're going to be people with testimonials about good experiences in any category. But just know what you're getting is the big thing there. So am I ready for business credit? How do I know? I've got my business, am I ready today or do I need to get ready? Is your business structured? Is it formalized? Is it registered? Are you registered with the Virginia State Corporation Commission? Do you have your articles of organization and incorporation, all your formation documents? Do you have regular and clear business expenses? You know what your business costs. I spend this much on inventory. This is what my rent is. I have ongoing purchases of supplies and materials, and I have that sorted out into separate bank accounts. I have my personal expenses over here, I have my business expenses over here, and the only way they interact is through formal draws or contributions. They're not all tangled up together. Then you have a plan to grow or expand. You need this capital for something. A good rule here is you only ever want to take on debt to invest. You don't want to take on debt for revenue. That's you can't borrow your way into positive cash flow. Your business must cash flow on its own. And then your business does it have the capacity to take on new accounts? So you can make all those payments that we just talked about. You know what your business costs, you know what your inflows and outflows are, you can manage them and whatever this new debt would be. So you go out, what are they going to need? What are they going to ask for? They're going to want your bank statements. Your business bank statements for sure. Usually with a personal guarantee, they're going to want your personal ones as well. Again, when you're first starting out with business credit, they're probably going to want to assess your personal credit worthiness as well. Your monthly income and expenses. Again, business and personal often when there's a personal guarantee involved. Your business's debt to income ratio. How much debt do you have that you're servicing month to month, and what's the debt schedule? Are you going to have something paid off in 12 months? Are you going to have it paid off in 10 years? Your cash flow projections, 12 to 24 months, sometimes up to 5 years of cash flow projections. What a lender typically wants to see is through stability. They want to see you project, okay, it's going to take us to this many sales per month, this much revenue at this expense level to reach stability, to break even. They also want to see reality, not perfection. So you want to typically underestimate your revenue and overestimate your expenses. Your tax returns, both business and personal, usually at least 2 years. Your business has financial statements, so your P&L, your balance sheet. So it's good to have a system in place, whether you're working with a professional accountant or you're managing that for yourself. You're going to want to be able to pull those reports pretty easily and say, here's our year-to-date P&L, pull that so that you're not having to go in there and do a bunch of legwork every time you need to go in and apply for credit. Your business has registration paperwork, your records, your federal EIN, any state, city, county licensure that you need, and then your organizational documents, your articles of incorporation, your operating agreements, your bylaws, things like that. And then a business plan. A business plan that lays out how you plan on using this money. It's not a business plan that you wrote 5 years ago that you're dusting off and handing over. That was the business plan you wrote then. The good thing is a business plan is a living document, so that old one is still very relevant. You just need to update it to say, okay, this business loan that I'm getting, this is how I'm going to use it. This is how it's going to help me grow my business. Signs you might not be ready. Your business is still an idea. It's not formalized. It's not structured. You don't have the cash flow to repay yet. You do not have adequate capacity to repay. Sometimes borrowing money, it's not that you're never going to be ready, it's you don't want to borrow at the wrong time. Sometimes you can borrow too early in your business's life cycle where you're chasing debt. You're working just to pay down the debt rather than working on your business. You might need to improve your personal credit. If you don't have any business, if your business doesn't have any credit history for itself, and they're going to be assessing your personal credit history, maybe you need to work on that right now. And in 6 months, a year, 2 years, you're ready to borrow off of that improved history. You're not formally structured with the proper licensure and the proper registration, or your business and your personal expenses are still intermingled. They're still all going to the same bank accounts, and you're paying for business expenses out of your personal and vice versa. You have disqualifying liabilities like delinquent federal student loans or unpaid child support or outstanding tax liabilities. Those things have to be at least in repayment. You have to be on an agreed upon formal payment plan to be qualified to even apply for credit at most financial institutions. And then if that's the case, it's not no, it's not yet. What do I need to do in order to prepare and go out and get good quality capital? And then one reiteration about fintech or financial technology. I spoke about this a little bit earlier. These are quick, convenient services. They're very common nowadays. And like I said, online credit is not all created equal. So there's some really good, square, reputable lenders. But the fee disclosure is not always clear. They advertise one thing, and then when you actually go to finalize it, it's a little bit different. Also, your data security can be a little bit inconsistent. And then the big thing is you just want to know what those repayment terms are. Is it going to undermine your business's long-term prospects to get this convenient short-term capital? We see that unfortunately a lot of the time is it's easy to get, but it's not always easy to repay. So best practices always have a plan to repay, not just the intention to repay, but an actionable plan. This is how I'm going to make this payment over the life of the loan. Borrow for investment, not revenue. Have it before you need it. So if you come into a lender, say it's with us, with PIFs, oh man, I need this business loan, I need it yesterday. Well, it takes 4 to 6 weeks to get through the process a lot of the time because there's a lot of due diligence. And the more due diligence it goes through, the cheaper it's going to be. So you want the higher quality credit that you really have to jump through the hoops on. Not that it's got to be a pain. I just mean that they're really dotting all their I's and crossing all their T's and making sure you can manage this. So start establishing it and working on it before you actually need it. So, hey, okay, I think we want to make a big investment middle of next year. Okay, we'll start getting that credit in place now for deployment when you actually need it. Separate your business and personal. This is huge. This is really, really common. There's a reason I've mentioned it a few times. Put Keep your business and your personal cash flows in separate accounts, but keep in mind that business credit is not a way to avoid scrutiny of your personal credit. They will talk to each other, they'll interact, and especially until your business has its own credit history. But keep them separate so that you can identify, you can show, you can demonstrate to a lender, here's my cash inflows and outflows. So a little bit about PIFs, People Inc. Financial Services. So I've mentioned the way we lend a few times. We are a nonprofit mission-driven lender, so we have a variety of funders, including grant funding, some funding from the state. We are ultimately an agency of community economic development, so we want job creation, we want economic growth, we want economic opportunity, economic activity. The more money flowing through our communities, the better. That's our ultimate aim. And on the lending side, it means we can be more flexible. We don't have a single credit criterion that is a disqualifier. We look at it holistically. These are still underwritten. We're not guaranteeing anybody money. We do still evaluate risk, but we evaluate it by looking at the whole package, not just one piece. And then we work in partnership. So we're in partnership with Capital Pathways. We're in partnership with the SBDCs, with our traditional lenders. We want to be a supportive partner of the entire ecosystem. And then we offer things like this, training and technical assistance, learning opportunities, because we want people to build the skills that they need to build successful businesses. We want more, not less. Here's a little snapshot at our credit products. The ones I was talking about mostly today are these business loans. They're fixed rate, fixed term for startup and expansion, and they are secured loans, but we have a variety of a few other options as well. And then we also have, as part of our program, Initiate, you can use this. There's a QR code if you want to send a request for an invitation. Everybody that we interact with has access to Initiate. It is a learning management platform for small business skills, for business management skills. So startup, marketing, money, and management for people to be able to learn in a self-paced, web-based environment on your own time. So that, the joke I make is that when you're trying to start a business, you get to choose which 90 hours a week you work. So how do you learn on top of that to continue to improve your skills? That's what Initiate is for. So you can request a link there. That QR code is also a link when you get these slides afterwards, or you can scan that QR code to send a request. Right now, completely free of charge. So questions here at the end of our session. It can be about any part of this. It can be about the content I just talked about. It can be about PIFs. It can be about capital pathways, anything you'd like to ask.
So we have a number in our Q&A queue. So I'll start at the top. Looking at the diversion is the word they use. Do you do anything with SDVOSBs that are also hub zone?
I don't know if I
I think they
totally
may.
understand the acronyms here. If you're talking about the SBSD, the Small Business Diversity and Supplier, we are a partner with them, not a formal one, but an informal partner. Um, and as far as like government contracting, we work with, you can be SWAM certified. We can work with businesses that are for profit, nonprofit. So we work across the ecosystem there. We don't have any disqualifiers to that effect, but we don't have any direct link to those programs.
I think SDVOSB is socially disadvantaged veteran-owned small business or something like that.
Yeah, so if you're, so yeah, veteran-owned businesses we do work with, again, not in a formal capacity, but we fit, flexibility is our feature. That's something I say all the time to our partners. So we work with in the for-profit sector, we work in the government contracting sector, we work in the nonprofit sector. So yes, we have worked with veteran-owned businesses as well, but no, again, not in a formal capacity.
Alrighty. And I just looked it up and correcting myself. Service disabled veteran-owned small business. So
Okay.
you covered
Yes.
that with talking about working with veterans.
Yeah.
All right. Next question. I have a credit score of 700 and above. How long does a medical clinic bill delinquency stay on my record, or what could be done to change that?
So the length of time is going to be based off that 7-year delinquency timeline. There was some legislation that just went through last year that medical bills under $500, so smaller medical bills no longer show up on your credit reports. Over that still does if it's a delinquency. And sometimes with places like that, if you have a collection that's been sent like that, if they haven't maybe sold it off to a third party collector and they're managing it in-house, part of the workout negotiations can be to get it removed, uh, which can benefit you if you're not able to kind of like grit your teeth and weather out that, because 7 years can be a long time, depending on what your goals are and depending on where you are in the timeline. If you are going to do a workout like that, make sure you get everything in writing. Verbal is not sufficient. So if they're going to say we're going to, you owe $2,000 and we're going to take $750 to settle it, get that in writing, get that formally so that you have that, you have some accountability to that effect. And the same would be true if you're going to ask if they're going to remove things. And then the way you would check that is going on and pulling your own credit report off of annualcreditreport.com say, and see if it's still showing up after the fact.
Thank you. If you need cash/credit to start building a business for business expenses, how might one obtain help or credit to for to apply to startup costs? Or is it expected that we have revenue over a specific period of time before applying for a business loan?
Yeah, that's startup expenses or startup capital is the toughest to get because your business is speculative and 1 in 5 businesses closes within 1 year. So it's just a high risk industry. So that's why traditional lenders are often reluctant to lend outright to a startup business. Does not mean it's impossible. It's always a matter of degrees. So usually there's a term in our space called your credit stack. That means it's some variety of credit. There's not usually not one silver bullet, one big loan that covers all of my startup expenses. Because a lender also doesn't want to feel like they're taking on all the risk for you. So they usually want to see some variety of personal equity injection. So you've put in some of your money, and then they'll do some, and then maybe you have another lender like like us as a partner, like a mission-driven lender, or something like that, where you get a variety. Now, some places say this is not available to startups at all. In that case, that's just you're going to have to go find another lender. So a place, frankly, and this is not, this is not like pitch hour, but like Capital Pathways is designed to help people navigate this exact challenge because every business is navigating this one that you just described is how do I get startup capital? So remember that it's a credit stack. It's a variety of options. And then over time, as you have more revenue over time, then more availables become or more options become available to you. So it's a little bit of both. Your question is well stated here, but yeah, it might be okay. I'm gonna think of it in phases. Okay, I'm gonna start this. I'm gonna demonstrate cash flow for a year or two, and then based off of those, I'm going to borrow a little bit more. What you don't want is to get the giant loan that you're trying to service all at once before your business is ready, because that in and of itself that can sink your business, is trying to service too much debt too soon. So think of it in phases. Get what you can get, invest your own money if you're going to borrow from Uncle Joe or whatever. And then as you grow and can demonstrate you have good structure, you have good capacity to repay, you have proof of concept, hey, there's a market for this. People buy my product or service. Then you will have more options available to you. Does that answer your question, anonymous attendee at 12:50 p.m.?
Thank you, Justin. Moving on to the next question. If I have a bankruptcy on personal credit report with all accounts showing paid as agreed and it lasts 10 years, does that mean I won't be in a position to qualify for consumer credit and or business credit? What about joint venture qualifications?
Great question. The answer is never absolutely not. It will be how much, the quality of. So as you're building, yes, you will be able to access something, but financial institutions will be a little bit risk averse if they see a bankruptcy in your credit history. Remember, as it ages, you want to replace it with positive action. So whether that can be getting a good, responsible credit card and keeping the balance at zero and managing that really well, that'll improve your credit utilization, that percentage that we talked about halfway through the training. And then as you show that and no derogatory items of any kind, no, absolutely. The answer is not. You will not be able to get it. It might be a challenge for some time until you've replaced it with good positive actions. But no, a bankruptcy is not the end of the world. What they don't want to see is habitual, that you keep doing it and you were bankrupt and then you had several accounts after the bankruptcy that also went bad. That can show a real demonstration of poor financial management. And that's what they're skittish about. So the big thing is just pay on time as agreed, and then the things in the past, let those age, and then eventually they will fall off, and then it will be as if they never happened because you've replaced them all with positive credit habits. With a joint venture, so whether you're talking about co-signing for a loan or co-borrowing for a business loan, if they are looking at a personal guarantee, they will assess your personal credit history. That's part of the personal guarantee. So in those cases, if it's going to weaken the proposal, we typically advise people not to co-sign or co-borrow, but if it's going to strengthen it, even on a net balance, like it's maybe there's a little bit more debt or a little bit more of a checkered credit history, but we really need this person's income to make the loan happen. We're happy in our world to advise people one way or the other. Hey, this makes it more complicated. Hey, this makes it a little easier. So it's an it depends question, but it's a really good one.
Thank you. I was looking to build business credit and obtained a business credit card from Amex. I was told it's better to get a business credit card from the bank in which I have my business account. Does this matter? I was also told that I should start securing business space to build business credit faster, yet I have no dire need to pay for space while I'm a micro business. Where should I focus my energy on to build business credit?
No, you don't have to get it through the same bank at all. That is a banker who wants more business. Not to, I don't mean to accuse anybody of anything, but that's how a bank makes business or, makes money is they have a portfolio of business from somebody. I will say it can be easier sometimes if they're all at one institution, but at the end of the day, you want to go where it benefits your business the most. And so if you can get a really great piece of credit over at this other place, but your deposit accounts are all with, Bank A, don't get worse credit at Bank A just because they're at the same place. But with that said, my business line of credit is with my retail bank because I want to be able to easily transfer the money from one account to the other. So that transfer is really valuable to me because when we're going to go buy merchandise, which is what we use our line of credit for, we need to be able to do it without a lot of hiccups. So that's me factoring in a service factor. But at the end of the day, we're also not paying that much for that credit anyway. It's not a huge loan. It's not, I didn't buy a commercial property or something. So that's gonna all of those factor. At the end of the day, you are the customer. You get what is right for you, but cheapest just by dollars and cents is not always cheapest kind of holistically. You want to look at how you're going to use it, what you're using it for. Um, and then business space. I mean, there are a lot of businesses that don't ever have a physical location. So I don't think I wouldn't pay for anything you don't need. Absolutely. That's in my opinion. I'm not a financial advisor. I'll make that super, super clear. That's ultimately your choice. But unless what this advisor was telling you was like, in order for them to start reporting your credit history or something, but even then you would want to confirm that they do that. And if it would even work towards that, you having a physical space does not necessarily factor into your credit history unless it's tied in somehow to the reporting bureaus. Oh, and then I guess where should I focus? And we're coming up on time, so I want to get to it. But where should I focus my energy? Um, Credit that you know will be reported in your business's name, paid on time, but also borrow within your business's means. You want to increase utilization. And then ultimately, at the end of the day, you want credit is not profitability. So that's where my business mind goes. Is where I would put my energy is on making sure my business is as profitable as possible. Because then when I go to apply for actual business credit and I'm going to get my term loan and I want to purchase a building for my business, I can show great profitability with really well kept books. And I can demonstrate that over time. That's what I would put my energy on.
Thank you. Real quick before we get to the next question, I do see that we only have about 4 minutes left in our scheduled time, but we do have a buffer of about a little bit longer if folks are able to stay on and listen to the rest of these questions get answered. All right, so with that said, kind of a follow-up
Before
question.
we move
Oh,
on, I'm going to click over this one slide. My contact information is on this slide. If anybody needs it, you can reach out directly to me with questions about PIFs or anything we've talked about today. It's been a pleasure to be here, and we're going to hang on and answer a few more of these questions.
thank you, Justin. I know there have been maybe a couple questions asking for your contact information. And for anyone looking for the contact information for Capital Pathways, I've dropped that in the chat. So please feel free to reach out to me there. Um, so following up on our previous question, the question asker was told that Amex cards are not credit cards and that they should apply for a credit card instead. What is the difference?
Not knowing your situation perfectly, American Express is a type of credit card. They're Visa, MasterCard, American Express, Discover. Those are the big ones. So it is a credit card, but it might have been some specific product you were looking at. So maybe I don't know if they were saying it's on a business credit card, but an American Express is a credit card. So, without knowing your situation a little bit more, that's what I can speak to. Michael Love said, please show the business is not ready for credit. Yeah, I'll happily go back to that, Michael. I can find it. Yep, there it is. Okay, next question.
Sure. Question asker says, hello, Justin. Thanks for the great information today. I echo that sentiment. Appreciate you being with us.
My pleasure.
Um, did you speak about the SBSS? I believe it's no longer required after March 1st, but will lenders still require it?
I'm not sure I'm familiar with this acronym either. Speak about the SBSS. Do you know what they're talking about, Allie?
I do not, but I'm looking in the Q&A for a response clarifying what SBSS is from the asker. I do have a clarification from the previous question saying that Amex has quote unquote charge cards for businesses.
That is a question about a specific product that I'm not totally able to answer. So sorry that I can't provide you more clarity on that. They probably mean that particular product doesn't count as a credit product. And that may be the case, but in as a certified credit counselor and not behind one particular product, I wouldn't be able to speak to that. That'd be a little bit out of my depth.
Alrighty. I am not seeing any follow-up on that, the question from the asker in the Q&A, so we'll move on to the next one. What is your best advice on how to get a loan or line of credit to complete a job or contract with a new or newer business, even if personal credit is not ideal, maybe only having a few revolving lines?
You're actually describing a great candidate for CDFIs. Not just us. There are CDFIs all over the state and all over Virginia has a pretty robust CDFI network, but they are also national. CDFI is a national industry. Also, sometimes local revolving loan funds, if it's in a certain sector of town, a downtown business, whether you have that or not. As far as new and newer businesses, those are going to be harder and riskier to lend to. And they're going to rely on your personal credit. And so finding somebody who can work with you in that context and be able to look at that kind of holistically. Also, smaller community banks usually have a little bit more underwriting authority, like decision-making authority in-house. So not your, big banks have their role. Obviously, they have a lot more capacity, but your smaller ones sometimes have more custom decision making. So it can be, that can be a little bit of a gray area, and everybody has to navigate that individually and uniquely. But that's where I would get started. CFI, local community funds, and small community banks.
Thank you. And I was able to look up what SBSS is. It looks like it's related to FICO and it stands for Small Business Scoring Service.
I did not speak to that. I am no longer required after March 1, but we'll still understand. I can't speak to that. I'm so sorry. I'm not familiar with that particular regulation.
Thank you. With the number of layoffs occurring and lost income affecting the ability to maintain credit, how is this considered when attempting to apply for business credit?
Yeah, that's something we're seeing a lot too. It is stability is one of the factors that folks are looking at, and it's we have folks in Northern Virginia who were affected by a lot of the federal layoffs last year. Again, that's where the credit story piece comes in. If what you're trying to make sure is that there is not some kind of wide inconsistency. They change jobs every 6 months or something like that. Um, it it will be a factor if you do not have the capacity to repay. No lender is going to lend you something that they don't think you can go out and make the payment each month. That's not how a responsible lender makes their money. And in my view, if you send somebody out without full confidence that they can repay, then you've done that person a disservice. So it is a little bit tricky, but if you have a coherent, hey, I was part of the federal government. I got laid off last fall. It took me 3 months to get repaid. I had some financial challenges during that time, but I've become employed again. 3 months later, we, at least in our kind of holistic approach, are able to take that into account. We've worked with some folks who are in that setting, but borrowing money is not just the borrowing is not going to make sure you can repay it or that your business is going to cash flow. So it's one piece of the puzzle, but it is challenging. So my sympathies are also with you for if you're navigating that right now, for anybody on this training today.
Thank you. Next question is there any option to work with people with PIFs if I'm in Central Virginia? The question asker lives in Colonial Heights and can't request service training schedule because it's not in a location drop-down option.
It depends on what part of Central Virginia. We don't It depends too. I know that I know that's not an answer to a lot of the questions, but email me and I will see if I can find. If we can't work with you, I'll try to hook you up with another CDFI that's in your region. Where, like I said, we're partners with everybody, so we want to make sure you get to the right folks. So shoot me an email, Elizabeth Cannon, and I'll try to get you hooked up with somebody.
Thanks. And just as a note for the Capital Pathways program, we are a statewide program. So anywhere in Virginia, reach out and we'll get you taken care of. What is your best advice to get a loan to purchase an existing business that and the business is in good standing?
That's gonna small business borrowing is one of those kind of we have a whole training on how to fund like small business financing beyond the credit piece. That's also going to be a factor of some money that you put into it, money from traditional lenders, and then maybe there's some alternative lender like a CDFI. So there's no one silver bullet. What it would be for there are some banks that have products that are specifically for business acquisition. So that's another one of those. You'll have to shop around, have develop a relationship with a banker that can help you navigate the system. But yeah, I would start at a traditional bank.
Thank you. Could or should you get a credit alerts for business credit the same as you would for personal credit?
If that makes you feel better, great. Do your thing. I don't know since these are pay services. I don't know exactly how that works. I've never had any need for the business credit bureaus in the small, but my businesses are very small. So that's not something we've ever, I've never started like a big manufacturer or something that's using major bits of business credit. Um, but that's something I would reach out, their pay services. So I would reach out to them directly to get some customer service on that.
Good to know. Is there such a thing as getting credit for those who are not
Mhm.
allowed to practice riba or halal lending? Question asker is wondering if you know any CDFI lenders that consider certain
Mhm.
religious restrictions.
Yeah, we have heard this request before. We are not in a location that their demand is high enough for these kinds of products, but these are going to be very regional based off the population. So places with a denser Muslim population are going to have products to that effect. We do not at PIFs, again, just because demand isn't quite there based on our service area. But that's a really good question. There are some places exploring this because I know there's some structural differences. I'm no expert on it. I just have some kind of introductory knowledge about it. But based on where you are, you'll have to look at that regionally.
Thank you. All right, so this is our final question in the queue, and it looks like it's a two-parter, so I'll try and break it up for you. Question asker has a small business that's been doing business for almost 31 years, didn't take any PPE loans during COVID, and also experienced some family issues and other diversions. They use their credit card for a source of financing and keeping the business alive. Their business is still doing good work and now being able to devote more time to it. They are reincorporating in Virginia as an LLC and need a loan to offset their high interest rates. Would it be better to work with you, Justin, at PIFs or Allie at Capital Pathways or both?
Hey, congratulations on keeping your business running so long. You are not alone. COVID was a massive disruption to lots of folks. And credit cards are really expensive. So, yes, I would say the short answer is yes. You can reach out to folks at PIFs or another CDFI, and absolutely the folks at Capital Pathways. Loan readiness and capital readiness is their thing. So, yes, absolutely reach out to Ali's team. And yes, sometimes consolidations are a big part of what we do. We do it. We've done it for folks with credit card debt as well as sometimes merchant debt. Where they get like transaction based debt. It's just really hard to keep up with your business at that that point, and just it's the same amount of debt all told, but restructuring it into a consistent monthly payment can help get a business back on its feet. So the short answer would be yes. Depending on the each CDFI is independent and has its own policy and its own missions and its own credit products. So what we offer and how we work and who we serve is going to be unique to us. So keep that in mind, depending on where you are. Congratulations on your move to Virginia as well. But yeah, I'd say consolidating debt like that would be a really good option. One of the things to consider with any lender is sometimes consolidating credit card debt can be seen as a little risky because it frees up those credit cards for more debt. And so you will need to be able to show positive credit behavior beyond just the consolidation, where they're going to want to see that you're going to be able to manage this. Okay, so if we pay these off and take them to zero, are you going to be able to keep them at zero while you're paying off this other debt? That can be a risk factor that you'll need to navigate.
So they had a second part to this question. Due to their debt to income ratio, traditional financing has not been an option through their bank that they've had for almost all the years that they've been in business. They actually told the question asker that they would do better with the bank as a new customer. Is that
Mhm.
something you've experienced before or can
I've never
speak
heard
to?
anything like that. Usually businesses want to retain business, I find, but I also see what they're saying, that promotional rates sometimes factor in because they are trying to attract new business. You are describing a really good candidate for CDFI lending, where it's somebody who, it's not that they're not credit worthy, it's that they don't quite fit into the traditional lanes. And they just need opportunity in order to build a bridge into that traditional economic lane. So, again, not just a pitch for CDFI, but I do work in CDFI and I'm proud of that. So, again, you could shoot me an email or Allie, get hooked up with her. This is exactly the kind of stuff they help folks navigate. And then, hopefully now you know that you have there are options beyond the traditional.
Indeed. And Justin, I see that you've had your contact information back up on screen for us. And just to remind folks that mine is in the chat. So please write that down, take note, click the links, whatever you need to do to have access to that. And with that said, our time together is at a close. Thank you, everyone, for all of your wonderful questions and for joining us today. Thank you, Justin, for all the excellent information and helpful tidbits that you shared with our participants. If we weren't able to respond to your questions in any way, shape, or form, please do shoot us an email. Um, we can help connect you with resources that can help and do our best to answer your question. As I said at the top of today's session, we'll send out a recording of the webinar in an email for everyone to have. But again, reach out to us if you have any questions, and we hope to see you all in future events.